There is a dizzying assortment of investing possibilities available to young people who want to start a savings plan. There are virtually as many distinct companies and vendors that promote them in a variety of ways as there are products and services to pick from. Thankfully, investing your money is not as difficult as it may seem. In this video, we will take a look at top 10 investment for young adults. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Saving for retirement. Time and compound interest are your greatest financial assets if you are young. Your main investing goal for your long-term investments at this stage in your life should be growth. Investors who start saving for retirement in their 20s will have at least 40 years to do so. As a result, you have to think about investing as much of your savings as you can in equities, such as ordinary stocks and stock mutual funds. You might also take into account real estate, either in the form of a private home or a REIT, a type of mutual fund that invests in real estate holdings. You will need every penny you can get once you stop working, so it's critical to be able to boost the purchasing power of your retirement assets throughout the course of your life. 401k and IRAs. Saving money for retirement can be done in IRAs and employer-sponsored retirement plans. Employer-sponsored plans frequently offer matching contributions, which can significantly increase your retirement savings. At retirement, a 50% match on the first 5% of your contributions might put tens of thousands of dollars more in your bank account. The majority of financial advisors advise young people to use a Roth IRA rather than a standard IRA because, despite the fact that you don't receive a tax benefit for your contributions, your money will grow tax-free until retirement and you won't be required to pay taxes on withdrawals. 401k programs are only one example of a qualified plan that offers Roth advantages. When you take money from traditional IRAs and 401ks in retirement, it is taxed at your personal income tax rate, and you are compelled to withdraw a specific amount, starting at age 72, whether you need it or not. In the end, it is nearly impossible to outperform the Roth over time due to the tax-free growth, no necessary withdrawals, and greater returns generated by stocks. Buying a home. Generally speaking, conventional financial wisdom has held that a home is among the best investments you can make, but whether or not this is true depends on a number of factors. This issue will be greatly influenced by the length of your stay, the state of the housing market, the current interest rate environment, rental rates, and your own financial status. Mathematically speaking, it typically takes at least 5 to 7 years to create enough equity in a home to make owning a home more financially advantageous than renting if you expect to live in one place for fewer than 5 years. Saving for college. If you are still trying to get through school or have not yet started, then there are several other vehicles for you to consider socking money into. 529 plans. This kind of college savings plan, which enables you to set money aside for higher education, is available in every state. Private K-12 schooling is now covered as well, but you won't likely have any issues with it. The money can be spread out among several investment options, and it will increase tax-free until it is withdrawn to cover eligible higher education costs. These plans' contribution caps are relatively high, and they can also save affluent contributors wishing to lower their taxable estates on gift and estate taxes. Coverdell Educational Savings Accounts. Another choice for people who prefer a more self-directed approach to their investments is this kind of college savings account. The current yearly contribution cap is $2,000, but it can still be a good option if you want to buy a specific investment that isn't available in a 529 plan. U.S. savings bonds. These are another choice for cautious investors who don't want to jeopardize their capital. In addition, interest earned on U.S. savings bonds is tax-free if used to pay for higher education costs. Short-term investments. No matter your age, the options for your short-term funds, such as an emergency fund, are essentially the same. Savings accounts, short-term CDs, and money market funds can all offer security and liquidity for your unused assets. Your individual financial position will determine how much you put in these investments, but most financial experts advise retaining enough to pay for at least 3 to 6 months' worth of living expenses. Young investors should know that investing in market tracking ETFs and allowing dividends and interest accumulate almost always outperforms a short-term stock trading approach over a lengthy period of time, such as their working years. Despite potentially significant gains, the majority of day traders fail within a year. In the worst situation, they lose all of their investment and can even end up owing brokerage interest on trades made on leverage. What are the easiest investments for young people? Although investing can be scary, you can begin investing without having a financial background. Mutual funds and exchange-traded funds offer a simple method to stay up with the overall growth of the stock market without having to go to the hassle of stock choosing. Why should you start investing when you are young? It is stated that compound interest is the only real wonder. While investing in your 20s will provide your funds several decades to grow, young people may make less money. A $1,000 investment in the stock market, which normally grows at a rate of around 7% annually, might be worth more than $7,000 after 30 years. You have even more motivation to use those advantages when tax-advantaged retirement plans and employer matching contributions are available. How to invest money in your 20s. It is best to begin investing as soon as possible. Young individuals have the chance to make inexpensive investments today that will look wise with a lot of time added. There would only be an exception if you had a sizable sum of high-interest debt to settle beforehand. Allocating more money early on toward speedy debt repayment might be preferable for you if the quantity of debt you hold overwhelms your personal budget and leaves little room for investing. You might also think about making tiny investments using applications like Webull to place your money in various investments as an alternative. Learn how Webull and Robinhood are funded while not receiving commissions. To counteract this free commerce, they monetize other goods and services. Bottom line: free trading expenses benefit consumers as long as they don't encourage excessive trading, potential capital eroding, or Uncle Sam payments. It's important for young individuals to acquire and hold both short and long-term investments. The ideal mix guarantees that you'll be ready for future retirement as well as large purchases. Today's investment apps, many of which were developed with millennials in mind, make it simple to start investing with little capital. Start improving your investment strategy right away. With a free software like Personal Capital, you can monitor the success of your stock portfolio over time and watch how your net worth increases. You'll be grateful to your future self. What are the best short-term investments for young people? Younger people may find investing difficult because they often have less spare income and may run into unforeseen bills. Saving money in a bank is not the best option, though, as little interest is earned on these accounts. Short-term investments like money market funds and certificates of deposit are excellent ways to grow your money while maintaining the flexibility to access it quickly. How long does it take to see results? Without a question, the most difficult aspect of long-term investing is waiting. The desire for quick gratification makes waiting to see the results of your labor seem tough, and millennials are infamous for having this desire. The same problem arises when we choose investments to retain for extended periods of time because we want benefits right away. Does anyone not? Even though we are aware of the magic of compound interest, maintaining motivation can be difficult. We might learn something about how even the most powerful investments begin small and take time to grow from the marketing of Acorns, another well-liked millennial investing program. In fact, since the majority of investment growth occurs later in life, taking a realistic approach to expectations for investments is probably ideal. When you invest your money initially, very little growth happens. The most crucial choice you can make as a young person is to establish a regular saving routine. It is less important what you invest in than that you have made the decision to do so. Your specific investment goals, risk tolerance, and time horizon will all play a significant role in determining the best assets for you. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.